Hey, what's going on, everybody? John here, doing a quick video for you on investing. The spirit of this video is really to address what's happening with all the red days in the market. Again, today it is the time of this recording. It is Thursday, March 4th, and we have had 3 red days in a row. Kind of big red days. Now, I do follow a lot of the growth tech out there, growth technology companies out there, and I've got my own little system for how I analyze investments and how I analyze businesses and when I decide to take a position in them. So basically, what I decided to do is I decided to go back to Warren Buffett and see what sort of advice he has and what sort of things that he says. Certainly in times like this, and what you really should be focusing on, and how many companies and how many stocks you really should be focusing on. And we're going to go ahead and do that. And we're going to talk about a couple that, during these times of what could be, a little bit of unnerving, trading activity and stocks going down. It's hard to understand exactly what to do. Really, I have another video where I've talked about some forecasting in terms of corrections happening between February and April, the reasons for those corrections, but also how it's important to really, if you have any margin, to really be mindful of that and watch that margin and really try to get rid of that margin, or at least trim that margin as we go into this correction, and then have some dry powder. Dry powder meaning you have some cash available so that you can pick up those companies that you really do like, right? So basically, I want to go in and show you some of these clips from Warren Buffett. I think they're pretty good. I think you'll be surprised by what he says. How many, it's really not that many businesses that you need to be right on that you can get rich according to him, or do really well, right? But before I take you in, everybody, hey, I'm adding value every time I can. Certainly multiple times a week. I got videos pretty much every Monday, Tuesday, Thursday, Friday, and Saturday. If you enjoy some of this value, go ahead and give us a like, and then also subscribe and put any questions in the comments area. So that would help me out a lot. We also have some links in the description area for other programs on investing, as well as generating income online. So I'm going to go ahead and take you into Warren Buffett right now, and let's take a look at what some of his tips are for finding the right companies, how many you need, and we'll go from there.
More than that, and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50.
So there you go. That was sounded like that was basically a point to go against diversification, which I don't know. I mean, obviously, I'm not going to argue with Warren Buffett, but when it comes time to actually making a decision, it does make sense, in my view, to actually go in and limit your exposure as you're going in. As you start to believe more in the company and you start to see it perform over time, certainly an example that I give is, and again, I mean, I do focus on growth tech, right? And I've got a little bit of a formula that I look at. Number 1, I look at gross profits. Number 2, I look at revenue, year-over-year revenue growth rate. I try to get in at a market cap that's reasonable, right? A market capitalization of 20 billion or less. And I also try to spot these opportunities of growth technology when the company is about to or has recently cleared $1 billion in sales annually, doing $1 billion in sales annually. And then also from a gross profit perspective, I like to see the highest, obviously the highest the better, right? But if you can get around that 70% number, that's something that I like to look at. But anyway, the point is, as you're going in, I mean, these growth tech, I mean, as they're, younger companies and they're getting bigger and bigger, you want to limit your exposure. It's fine if you really feel strongly about going in, going all in or going over, something like 20%, exposure of your portfolio, your net worth to that investment. But you're not going to really build that confidence until you have some exposure to that investment over at least a little bit of time. In my example of Netflix, I started investing in Netflix actually in 2011, 10 years ago, and they had about a market cap of about 3 billion. And at that time, their sales were actually above a billion. Their sales were about 3 billion. So their sales matched their market capitalization of 3 billion, and they've gone up. Their sales have gone up quite a bit. So their sales in full year 2020, their sales were about 20 billion, and they're looking at they're forecasting 25 billion for 2021 in total sales. So it's really that system of spotting an opportunity where you can go from 1 billion, and then just like they're going to go, from billion in sales, these companies that are going to 10x from 1 billion in sales up to 10 billion in sales, and then of course stick with them as they get bigger and bigger, right? So this other clip I have of Warren Buffett is great too, and he talks about advice that he gives to students, and it's a little bit clearer than three, because I think three businesses, if you're really, really, really good, and obviously, Warren Buffett is really, really, really good, three businesses is great, but you want to accept the fact that you might not pick everything you pick is really might not be a winner, right? So that's why you want to have more picks than three. But let's take a look at some of his advice right here.
On a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich, because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I've formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually, $6,570 million from 1 penny. You think Coca-Cola is worth a penny more than Joe's Cola? I think so. So and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future.
So there you go, right from Warren Buffett. So inconsistent with my point about Netflix and having your own little model and applying that to what you understand, I want to go ahead and talk about one particular opportunity which might kind of fit in line with a little bit of a hybrid between value and growth, right? And that's actually Twitter. I think what's interesting about Twitter is one thing I have the ARK investment, the ETF, which is the the next generation internet, and their positions have certainly changed, very quickly actually, because they're making buys and sells all the time in their ETF, and their fund has grown. I actually have another video, if you're not aware. I'll put that in the description area as well with respect to ARK. You can go on their site, and I show you how to actually go on their site and subscribe to their trade alerts, right? So they're going to actually show you exactly what they're buying and selling every day, which is certainly very valuable information, because you could go into their website and look at all the different positions of their ETF and see how those positions are actually changing, week by week, or maybe not necessarily day by day, but you can see how the positions are changing, week to week or month to month. But let's take a look real quick here. This is the ARK Next Generation Internet ETF. Yep, and Tesla's still pretty much number one for them. Their number one position about 9.56, and I have seen them pretty much every day, buying some Tesla. I guess as Tesla's come down quite a bit. At the time of this recording, here it is. It's Thursday, March 4th, and Tesla's got a price of 621. So they've come down from quite a bit, from their 52-week high, which their 52-week high is about 900. So, obviously ARK is taking an opportunity to purchase some Teslas. Their shares are a little bit lower. And for quite a while, for months actually, I could see Roku in their number 2 spot, but that's actually shifted around a little bit. We got Square at number 2, Grayscale Bitcoin Trust, which I actually, I'm not really buying any Bitcoin directly. I would personally prefer to buy into, ARK and have that exposure to Bitcoin through ARK, or have some positions in the Grayscale GBTC, which is the Grayscale Bitcoin Trust, as opposed to directly into Bitcoin. And then here we got Roku at number 5 now, so from number 2 to number 5, but still about 3.9%. And then some of these investments were not in here before. When I say before, I'm talking maybe Q4, right? I was doing a lot of videos on ARK in probably like a December timeframe, December 2020, that is. And Twitter wasn't in there, PayPal wasn't in there, and Netflix wasn't in there. So it is certainly great to see them, right? But I think Twitter could be very interesting, because Twitter, while Twitter certainly hasn't done bad over the last year. A lot of this growth tech have gone up a lot. Like, for example, Tesla went up from January 2020 to January 2021 like 1,000%, which is pretty remarkable, to have an investment like that go up that percentage in 1 year. It's going to be hard to find something else that's going to do that again. But basically, with respect to Twitter, they did about 100%, right? So obviously, very good return by any measure. But at the same time, Twitter still has a pretty small market cap at about, where is it? Let's see. I think it's about 50 billion. Again, here we are, March 4th, 50 billion, 53.2 billion. Is Twitter's market cap. The problem with Twitter is, they've got the lowest year-over-year revenue growth of anybody on my list, right, at 7%. So I think that what happened is, I did do a video recently on Twitter, and I'm going to go ahead and link that in here as well. And they had a recent, it's really just a press release, and that press release is how they're going to allow content subscriptions and user tipping. I'm not really gonna, I'm not gonna, claim that I know that they're copying, that they're taking a page from the book of OnlyFans. There's a website out there called OnlyFans, and they have grown significantly. Basically to break down the economics. I'm not going to break down all the different economics of OnlyFans, but it's pretty compelling. Nonetheless, with respect to OnlyFans, and again, this is something that I found from December of 2020, and it's from Influencer Marketing Hub, right? And basically, so far, OnlyFans has paid out $2 billion to their creators, right? Is that right? Yeah, 2 billion to their, yeah. So they've paid out 2 billion to their creators. Obviously very significant. So the fact that as Twitter is as big as it is with respect to its traffic and being, let's say, a quasi social competitor to Facebook, and nowhere near the size of at least market cap wise to Facebook, or even annual revenues, right? Twitter's right there at about 3.5 billion annual revenues, which is still pretty good. But basically, they could really help that revenue growth with content subscriptions and user tipping. So we'll have to see what it does. But if you look at Twitter from a little bit more of kind of a value play with respect to, some of the tech out there that has equivalent, amount of traffic and stuff, it could be something that's interesting to take a look at and to consider. So yeah, I'll go ahead and link that Twitter video down here below as well. And hopefully you enjoyed some of that. If you want to go back, what we'll do is we'll go back to ARC here real quick and take a look. Twitter, PayPal, Netflix, Roku. So yeah, I mean, you basically, obviously you can invest in those ARC ETFs, if you, believe in their philosophy, their investment philosophy of investing in innovation. Certainly have, it's been a rocky road this week. Tomorrow's another trading day, and the reality is with all these red days, that we've had, it might be, a good opportunity to consider, kind of taking times to buy things when things go down on red days. So hopefully you guys like that. You enjoyed some of that, some of those tips from Warren Buffett, and you kind of formulate your 20 picks. I actually did do a video recently where Warren Buffett was talking about Bitcoin, and then he closed with the fact that as an investor, you should focus on 8 to 12 companies. And I did choose my 8 to 12 companies. I'm going to link that below. I'm not going to say all those 8 to 12 right now. I just wanted to give you a couple Warren Buffett, little tips and some inspiration, and talk a little bit about Twitter and show you how that might be an opportunity for this year. Okay, so hey, I'm going to put a link down below as well for a blueprint that I came out with. I cover investing, I cover online income, I cover credit, business credit, financial independence, and at the very end, I've got about a 15-page guide, all the groups in the U.S. to give you a free credit score, plus all the groups to give you a free FICO score and the corresponding bureau with that FICO. And yes, it does include all 3 bureaus, so that way you don't ever have to pay for a free, or you don't ever have to pay for a FICO score again. And I'll put that link in there below. Okay, have a great week, and if you have any questions, put them in the comments area.